things. But next, we're ready to make a major shift into the traditional below-the-line deductions that are for itemizers, which means if you're taking the standard deduction, you don't get any benefit from these anyway. The only benefit comes if your total itemized deductions exceed the amount of your standard deduction. And the first one to talk about there, it's another one that's getting a lot of headlines in the media, the state and local taxes deduction increase for the years. Now this one, we're going to be talking about 2025 to 2029. Can you talk about what's going on with state and local taxes, or SALT as the acronym goes?
So we've all had to live with the $10,000 limitation since the Tax Cuts and Jobs Act, and that's been moved up from $10,000 to a $40,000 deduction, which is not perfect, but it's great relief. Deductions are a matter of legislative grace, but I'm kind of a economic thinker, and I think that if you don't get a deduction for your state and local taxes, you're getting taxed twice on your same income.
Mm-hmm.
But that's
you had shared that the history of state and local tax deductions going back to the 19th century. Yeah, that was a pretty interesting article.
There's a long tradition of giving people their SALT deduction until just very recently. But the phase out for married filing joint starts at $50,000 of modified adjusted gross income.
500,000.
500, yeah. I don't know. That's what I meant to say. It's gone at 600,000. And so it's basically a 30% reduction. It doesn't go to zero. It goes back to that $10,000 minimum. But, that can be brutal during that $100,000 in the sense that your tax bracket, you think you're in a 32% tax bracket, you're really in a 42 type percent tax bracket approximately, and that's if the other phase outs aren't also impacting you. QBI and SALT can phase out kind of in the same area, which is brutal. The other disadvantage is that single people get the same phase out range. So if you're in California and you're both working, in reasonably high paying jobs, it's easy to fall within that 500,000 to 600,000 AGI range and be subject to this phase out. And just by looking at the brackets, just to harp on the point, if you just looked at your brackets, you would have thought you were in a 32% marginal tax rate, but that's not the case at all for folks in this phase out area.
Mm-hmm. Yeah, $1 of income, you'll lose 30 cents of the deduction. So your 32% bracket becomes 41.6. This also could impact the 35% bracket, which becomes 45.5%.
Yeah.
So folks doing Roth conversions, this might be one of those things that it's going to be a break on the Roth conversion. You're not going to want to.
I'm at a 32% bracket. I'm just in it. I'm still going to do my, $10,000, $15,000 Roth conversion that was, that we had set up, done the planning for 2 or 3 years ago. All of a sudden, you're really converting into a 50% federal bracket, and if you're in California, you're paying another 10% on top of that. So is that Roth conversion really going to work out? Possibly, but it's going to take longer for that to break even as you build up tax-free income post paying the taxes on it.
Yeah, and probably have to be kind of a special case for anyone to target an effective marginal rate higher than the highest tax bracket of 37%. So that this is forcing you quite a bit over 37%.
Right.
It's a rough one for
Yep.
sure.
Yep. Yep.
Okay, the next one on the list, so we're talking about below the line deductions only available to itemizers. And also, so a point about the SALT is once that starts phasing out, you might be done worrying about it before you get all the way down to 10,000, because once your total itemized deductions get back down to the standard deduction, you don't have to worry about this anymore. It's really, you had
Right.
other itemized deductions as well, so that we're the full phase out, even with the $10,000, you're still itemizing at that point.
Yeah. There's some wrinkles, like, you point out if the math gets complicated based on the facts, then there can be some real abnormalities, or as you say, nonlinearities. And again, that's why you really need to do a full tax plan with full tax planning software, so you can uh, start to really see all those sensitivities and nuances.
Mm-hmm, mm-hmm. Okay, the next below the line itemized deduction, there are some changes made to, and we should mention there's others that weren't impacted by the law, like medical expenses is the same as before, but we're just talking about things impacted by the new law. The
Mm-hmm.
next one on the list, charitable donations had
Yeah.
some changes.
Yeah, have a lot of changes. This one really scares me. So we now have a 0.5% floor on all our charitable donation deductions if we choose to itemize. And uh, oh man, now they've got their nose under the tent, meaning the tax law, at 0.5%. And if we can go back to the medical expense deduction, I can remember when the floor on medical expenses was 3%. Well, now it's 7.5%. And if you go back 10 or so years, it was even worse. It was 10%. So this is now a channel
Mm-hmm.
where they can raise some revenue and nickel and dime us, and hopefully keep our uh, pain threshold low enough that nobody notices. And I know I shouldn't be so cynical, but I've seen it before, and I fear it's going to happen again here. So, if say you had an AGI of 400,000 and you had 15,000 of charitable deductions, this floor, as it's currently engineered, would only take away $200,000 of your charitable contributions. You still be able to deduct 13,000.
Yeah,
But
2000.
so pretty painless, irritating, but pretty painless. But let's say you have an AGI of 5 million. Now, even at 0.5%, your haircut for charitable contributions is 25,000. And if you have that much AGI, your SALT deduction is only $10,000. So that's all gone. And you have a massive amount of SALT with that much AGI, especially if you're in California or New York or New Jersey, right? And then you're also probably staring at the overall 35% limit on your itemized deduction. So I haven't penciled that out mathematically, but it may be demotivating for charitable contributions from wealthy folks. So we'll have to see how the tax paying population behaves to this provision.
Yeah, and it's also complicated because now with itemized charitable donations, you have a floor, an AGI floor, and an AGI ceiling that you
Yeah,
have to keep track on
yeah,
both sides.
yeah. And there's some real uncertainty, although it's getting clarified a little bit about Uh, do I just lose this amount floor forever? The simple answer is yes, right? But as it interacts with donations of long-term capital gains, appreciated property, which are 30% AGI limited, then it gets complicated. What do I lose? What's my carryover? And that's tax nerd stuff. But hopefully, we'll get regulations when the government reopens that will help us clarify that.
Okay, and also to note that begins next year. I forgot to mention.
That
I
begins
think
next.
most,
So
except for salt, everything we're now talking about begins next year for the rest of this part of the
for
conversation.
so this is the year. This is the year to do a donor advised fund. If you don't want to do the full route, CRAT or CRUT, and max out your appreciated stock deduction, and then you can decide who to give it to later. But that point is really worth considering because it's your last free shot at a fully appreciated stock deduction.
Mm-hmm. And then next year, like we were talking about before, if you don't itemize, you do have that nice bonus $1,000 or $2,000.
1,000 or 2,000, right? And again, that's perfect for folks that are, the mortgage is paid off, they're live in a low tax state, they're not massively charitably inclined, but they still want to contribute. So take your non-itemized deduction at least up to the 2,000 married filing joint again for your cash contributions. And then we got to start doing bunching. But the bunching calculation becomes more complicated now that we have a floor on charitable deductions and a 35% limit total and a SALT phase out. So the math and the strategy becomes a little more complex.
It does. Yeah, and then the next one, so the next one's a little bit easier, although maybe you'll find some nuances that make it less so. But starting next year, mortgage insurance premiums on mortgages used for acquisition
Right,
are
right.
deductible.
Their deductible is qualified interest. The phase out is mind blowing, though. You have to have an AGI of less than about $110,000 to take advantage of that deduction, and so a lot of people will be subject to mortgage insurance for first time, second time homeowners, but they won't be able to deduct it because it'll get kicked out as a result of the phase out rules. And the standard mortgage deduction hasn't changed, but is now permanent, I believe, at $750,000 of total acquisition debt, and which works well, in mid America, on the coasts, here in Orange County, a starter home's at, $1,200,000, $1,300,000. So even a first time homeowner has already hit the limit in Orange County, California.
Yeah. And I'll note too, the reverse mortgage community is excited about this one because there's some deduction bunching strategies around paying down strategically interest on acquisition, like debt from the reverse mortgage, and now also being able to add the ongoing 0.5% mortgage insurance premium.
Yeah.
At the margin could add some value for reverse mortgage cases.
Yeah.
Home equity conversion mortgage.
And it's not home mortgage, annuity or reverse mortgage is a viable strategy, and really needs to be considered, especially if you have folks that are starving themselves, trying to squeeze by on Social Security when there's no reason for it. they're living in a $2 million house, and tap it. I mean, don't punish yourself, and leave a $2 million house to your kids. Uh, Leave them less equity, and enjoy that middle to last part of your retirement.
Mm-hmm. Now for this next one, Alex, let's quiz you because this may be relevant to your life. You go to the casino.
Yes.
You're playing at the, what are you going to play? Roulette, backgammon? I don't know.
Baccarat.
Poker.
Baccarat.
But you
Baccarat.
Baccarat. That's the one.
So 90% maximum loss.
Well, don't tell them. Don't tell them.
Come
So at one point in the day, you're up $100,000 in winnings. You're like, oh, I could walk out with $100,000.
Yes.
But you just can't. You can't stop yourself. You keep going. You lose that $100,000. So you walk out at the end of the day back where you started. You were up $100,000. You lost $100,000.
Okay.
How much taxable income have you generated for yourself?
Well, I'm gonna pose this answer, and Wade, you know that I'm just walking in here, and I have no computer in front of me. This is Bree's laptop, so I'm not doing anything. I don't have my phone. So let's take a bet. Do you think I know this answer? I bet you $5 that I know this answer. Do you bet against that or not? All right, $5 if I win. I'll give you $10 if I lose.
Oh.
See, am I bluffing now?
Now you're creating complicated tax situations for us.
No, yes, exactly. But you gave me that
make a
question.
record.
I'm going to pose it to you as a bet. Do you want to take this before I answer this? Do you want to take this bet?
Well, I'd say you do know it, because you had this document to read before the episode. I guess it's a test of whether you read the document.
You're wondering, did I read the notes beforehand? That's what you're wondering.
Did Alex read the notes beforehand?
Have I read the notes beforehand? Wait, come on. Do you want to take that bet? You put me on the spot, I'll put you on the spot. $10. I'll give you $15. I'll give you $15 if I get it wrong. You give me $5 if I get it right.
All right, I'll take the bet. I'll take the bet. I think you didn't read the notes.
I pay only 90%. It's only 90% that I can get back. So I'm screwed 10%.
Oh, you know the answer.
I'm not
But
sure.
that's going to be starting next year, this year.
Oh, no. Don't give me on the year. No. Brett, does Wade owe me $15? Be honest.
In 2025.
Based on
Does Wade owe me $15? I think he does. Wade, I'm going to see you on Monday, so you know what's up.
Yeah. Wait, I thought I owe you $5.
No. I said, oh, yeah. You're right. I would give you 15. Yeah, you owe me $5.
I'll get you some lottery tickets.
You have little faith, Wade. Brent, did you think I knew the answer?
Was vague enough, Alex, that you really didn't answer the question.
90%. From a loss standpoint, I can't claim. It's not a break-even washout. I'm still on the hook for 10% of the gain.
And that's the new rule. It used to be a wash, but it's not anymore.
Yeah.
Brett, if you could.
Did I get it right now, Brett?
Speak about that in an accounting way rather than a informal way.
It's brutal for professional gamblers because they're trying to deduct their ordinary and necessary trade and business expenses, and that gets pooled into their losses. And if they're operating on a pretty thin profit margin as a professional poker player, they're going to be paying a lot of phantom income.
I see what you're saying.
Not that they weren't trying to stuff their entire lifestyle through their gambling expenses, but it's going to be serious. We'll see if that holds up.
I would, maybe I'm living in, maybe there's a world I know nothing about, and I can't imagine most of our listeners are professional gamblers. I just don't think so. But don't they probably net out negative? I just think of them like day traders. And day traders, I mean, it's not this huge industry. This is like, people that maybe last 3 years maximum doing this, and they move on to do something else. So how consequential is this in the big picture?
but your W-2Gs are on your winnings. Your losings are your documents to keep and your accounting records to keep. And I've done tax returns for people that, you add up all their W-2Gs and they've actually won a couple $100,000.
Oh wow, so
They've
that's me just being
thrown
unaware.
another they've thrown another $300,000 away, so they're a net negative 100,000. But they're drinking so much when they're gambling, they don't keep any records, and it becomes a real problem on an IRS audit if you don't have substantiation. Then the field agent is just going to give you zero losses. And again, you'll do a little bit better in appeals, but now you have to take your audit up to the appeals level just to try to net to zero on your couple 100,000 of W-2Gs. So it can be a real problem for what I would characterize uh, problem gamblers or marginally problem gamblers that have too much time on their hands and too much money in their bank account.
Yeah.
Wait, does this
It's
hit close
probably
to
an
home?
area.
Does this hit close to home?
No, I'm good. Yeah, this one's probably not impacting as many of our listeners, but we want to be comprehensive about all this. Yeah, you no longer can deduct 100% of losses. It's 90% of losses. And now we are getting a little bit into the
So
weeds with the next.
out of the
Oh, I thought
$5,
we
wait,
were.
out of the
I
five
thought we were
dollars,
done.
out of the $5, how much will you deduct? Out of the $5 that you were giving, how much will
Yeah,
you
that's a
deduct?
loss. I only get to deduct $4.50. Although I need gain. Or no, I guess I don't
I
need.
got lost. I thought we were done. Are we going to redo another session?
We've only just begun. Unless you have time constraints.
Karen
Okay.
Carpenter over
Well,
here, ladies and gentlemen.
we'll cut that part of the tape out. Hopefully.
We don't edit.
Oh no, it's hilarious.
Yeah, we push
Okay.
forward.
We roll.
But this one's probably a quick one. There's no longer any miscellaneous itemized deductions. However, there are some new like educator related expenses
Right.
that can be
So
deducted.
the only thing that's left out of miscellaneous itemized deductions are basically the K through 12 teachers, administrators, coaches. You have to work 900 hours in a real school to qualify for that, but then you can take that as a sort of a itemized miscellaneous itemized deduction, substitute. But most of those folks, in all honesty, are going to be standard deduction people. So I don't view that as being, uh, too prevalent. And then the only other one that remains, which is also really niche, and it's when you have accommodation expenses for work for somebody who's disabled, let's say in a wheelchair, and they need a lot of specialized equipment at their desk, that's still deductible. But that's basically it.
Okay. And then the final one of these below the line deductions is the 2/37 rule on your below the line itemized deductions.
Okay. So once you take your taxable income and add back your itemized deductions, if you're in the 37% bracket at that point, then this cutoff applies. If you're deeply into the 32% bracket, greater than your itemized deductions, then your itemized deductions are just reduced by 2/37, right?
So just
If you're
effectively, you're not getting a 37% on the dollar deduction. It kind of caps out at 35%.
5%, correct. That's the thinking. If you're somewhere less than that, then only the portion of your taxable income hypothetically plus your itemized deductions that are in the 37% bracket will be subject to that 237th phase out.
Okay.
Right.
I think
And this,
we're already probably 2 episodes deep into our conversation here, and we finally finished all these below the line deductions. There's probably another episode of content if everyone has time to talk about some of the other provisions. You guys
sure,
good?
I'm happy to keep going. I just,
Great.
I'll try to stay politically correct and
Won't
not
stop,
get.
can't stop. Won't stop, can't stop. Let's go.
Okay.
So
Okay.
we're done with deductions, and we're going to talk about some of the other main provisions of the one Big Bill Act that was passed in July 2025. The next one to mention, you had just said trying to stay apolitical, but this is the one that probably has the most political nature to it because of the Social Security Administration kind of writing a very confusing email and sending it to a big chunk of the US population. Social Security benefits. Are they still taxed, or did the OBBBA do away with the taxation of Social Security benefits?
No, they're still very much taxable, and they're taxable, with the old formula
Mm-hmm.
for, almost all the clients that I see. The 85% of your Social Security benefits are taxable.
Up to,
And,
yeah, up to 85%.
so I think there's kind of two populations. The population that I don't see are the folks that don't pay taxes on Social Security because their incomes are so low. And then there's that narrow range of folks in a phase out. And your planning guide sort of points that out as a tax torpedo. And
Mm-hmm.
it really jacks up your marginal rate, but it's over a very narrow range. And the other thing that happens is our IRMA adjustment, right? And again, most higher net worth, higher income people are just they're just taking it, and basically they're paying as much for Medicare as they used to pay for health insurance.
Uh-huh.
But
Yeah, and so
again, those people are enjoying the broader and lower brackets, and they can afford it anyway. It's not a cash flow shock when they're Medicare is costing them 15,000-16,000 bucks a year.
mm-hmm. Yeah, right, and that's not changed, and up to 85% of Social Security is taxed. I think if you could kind of say anything about the email, it was just trying to imply if the only income you had was Social Security and you're 65 and older, the additional deduction that you get at 65 and older would probably mean that even the taxable portion of your Social Security is less than your below the line deduction.
Yeah,
And so in that regard, it wouldn't be taxed.
So you're
But
saying the
yeah,
whole
it's
thing
really
is
only
a moot topic in the sense of they gave it to people that were kind of already wouldn't be paying it anyways?
right. In terms, there's probably a very small percentage of the population that actually would no longer have any taxation on their Social Security because they probably either already didn't have taxation on their Social Security or they have other income sources
Yeah,
too.
and
So
that's what I just want to get. But
might
to
some
your
people.
point, it's still going to affect enough people that when you get to the higher ups, look, you're just going to have to accept 85% of it will get taxed.
Mhm.
yeah.
Yeah, once you're through the tax torpedo, and that has not changed at all. That it's the same rules as before. I don't
And,
have to
and
change
your
anything.
and your net cash Social Security check is going to be really small because your IRMA adjustment is
Oh
pulling
yeah,
another 15, 16, 17,000 bucks out of your
yeah,
annual gross Social Security, right? And those folks have until they have a catastrophic cancer event or a dementia type issue, they're never going to have medical itemized deduction anyway.
So I should
You
triple
know?
my Diet Coke consumption. As many chemicals as I can get inside my body to to take advantage of Irma, to not be subject to Irma.
Because your medical expenses. Well, that's below the line though, anyway. So you
Oh,
can't
that's
avoid
right. That's
IRMA
right. That's
through.
right.
Yeah, you
I can't
can't
even do it
avoid
like
earning.
that. Yeah, I can't even do it like that. Damn it.
Yeah, that's a tricky point. It's any below the line deduction does not help avoid IRMA or Social Security benefit taxation because they're based on your adjusted gross income before you take the below the line deductions.
Yeah.
But others have been fooled by that nature of the tax code. The next thing, and now that we're a few episodes into this, by the time this is broadcast, something may have changed. But let's talk about the Affordable Care Act, and that at least the One Big Beautiful Bill Act did not
Yeah.
extend the higher subsidies to individuals who are getting health insurance through the Affordable Care Act. And
Yeah.
so unless something changes before the time of this recording, and it's still possible something could change before the end of 2025, subsidies for the Affordable Care Act may look very different in 2026. Well, and it would go back to how they were in 2020. We've had this enhanced subsidies from 2021 to 2025, and there's a real whammy in there if we don't have those enhanced subsidies. If you talk a little
Right.
bit about that.
And so, this came in when this law first came in, and we got advanced credits. What year are we talking about? It's a pre TJ, Tax Cuts and Jobs Act. Tax preparers were put in a very difficult position because people were going to the exchanges. They were massively underestimating their income. They took their monthly premium down to very low levels, and then they put the police force. They made us the police officers for the Affordable Care Act, and we would have to reconcile their advance credit to the credit they actually earned based on their real taxable income in their tax return. And these folks were always used to getting refunds, and now they had to come up with $5,000 or $6,000 for folks that are moderate income people, and they were just awestruck, angry, jaw dropped to the top of the desk, and they just couldn't believe it. But it was a self-inflicted wound because they were the ones that were so aggressive on what they thought their income was going to be that they totally blew their advanced credit out of the water, and they were paying $200 a month for their health insurance off the exchange. So then we kind of, got most of those folks in line, so they realized the consequences of their actions, and things were pretty good. And then COVID came along with all of these accommodations, right? And then people in certain categories didn't have to pay back all their advanced credit if they took too much too early. And that's all going away under this rule. There are a few what I would call positives under the One Big Beautiful Bill, in that bronze plans and catastrophic plans off the exchange now are considered a high deductible healthcare plan, and so you can qualify for a health savings account uh, with those plans. So that gives a new class of people a shot at HSA accounts, which, I think it's oversold, but they're correct when they say that's a triple tax free account. And as long as people realize that they're taking a bet on their good health, if they have a high deductible plan, it really can act as an accumulation vehicle for years and years, and they can have a tidy sum of money in that HSA, they get kicked off of it once they go to Medicare, but they can continue to pull that money out tax free for all their uh, healthcare expenses in retirement, which, as we age, are going to go up. So it can be that aspect of it I really like. And then we're in the middle of a government shutdown, and that's, from my perspective, the tax impact plus all the other one big beautiful bill stuff that's just more healthcare specific. That's all in play right now. So I think it's to be determined how much of that will survive, and if there'll be a political compromise off the existing legislation.
Understood.
Mhm. Yeah, because right now, if there's no change made in 2026, the subsidies end right at 400% of the federal poverty line, which for
Right.
a two-person household is in the ballpark of
Yeah.
$80,000.
Right.
Right now, you could continue to receive subsidies with hundreds of thousands of dollars of income if you're in a part of the U.S. where your benchmark plan is high enough for the premium.
Yeah. Like Orange County, California, for
Mhm.
example. You know.
And so there's a significant, it's like kind of like Irma, but even bigger impact. $1 too much income, you could lose $15,000, $20,000 of subsidies just from that $1 of income.
Yep.
And that makes the tax planning around not accidentally going slightly over your 400% threshold incredibly important if you're getting health insurance through
Yep.
the Affordable Care Act.
Yep. And then a lot of people just won't qualify anymore. They'll actually get kicked off the exchange if they're a non-citizen that don't fall into a specific set of requirements, right? And so that's the whole argument is that there'll be folks in the world, in the United States, that don't have access to health care because of the law change.
Or just the premiums are unaffordable, like a household probably
Right.
living in California, maybe making $90,000, $100,000, now looking at health insurance premiums in excess of $20,000, may just not really be able to fit that into the budget. That's
Yeah.
part of the
Yeah.
discussion as well.
Yeah. Well, you could always move back in with your parents.
Yeah.
That's an option.
None of my kids have come home, so I'm grateful.